Look, the Department of Justice is officially probing valuation practices at a massive BlackRock private credit fund, and that single headline should stop you absolutely cold right in your tracks. Not because BlackRock is going to magically vanish into thin air tomorrow, because it is certainly not, and not because a federal investigation automatically equals criminal guilt, because it definitely does not. Nothing has been proven in a court of law yet. However, the single biggest, scariest, most systemic problem in the multi-trillion-dollar private credit world is exactly what they are probing right now. Valuations. For years, there have been massive screaming questions about how these private funds value their loans, and this news just moved the entire conversation up a whole notch or 10. The question every single one of us needs to ask ourselves right now is very simple. How much are all these billions and trillions of dollars in loans actually worth? And who on earth gets to decide that number? What happens when the banks, the regulators, and now the Department of Justice stop taking these marks on absolute blind faith? That is the real story here. It is not about one specific BlackRock fund, it is not about one Blue Owl share buyback, and it is not about one isolated dividend cut at a Carlyle business development company. The story is that the private credit cycle is moving deeper into the dark, ugly phase where trust officially breaks down, and once the issue becomes trust, the problem is no longer just about potential credit losses, it becomes a massive funding problem. It becomes a collateral problem, and it becomes a massive liquidity and redemption problem. It turns into banks pulling back their leverage, insurance companies aggressively reassessing their exposures, and eventually it becomes a textbook credit crunch. We have a cluster of stories hitting the private credit bus right now, and every single one of them points in the exact same direction toward escalation. We have the DOJ probing BlackRock, we have massive headaches for funds at Apollo and KKR, we have Carlyle cutting its dividend, and of course Blue Owl is out there buying back their own shares in a frantic, desperate attempt to keep their stock price from cratering completely. This is a pattern, my friends, and it is a textbook pattern of what stage 2 of a massive systemic credit bubble pop looks like. Now, the reason this BlackRock story matters so much to you, even if you are just a long-term investor in simple index funds, is because the entire private credit boom was built on a very simple, very seductive, and frankly dangerous promise. The promise was, do not worry about daily market prices, because these loans do not trade every single second like stocks. They do not have the same volatile, brutal price discovery as U.S. Treasuries or high-yield corporate bonds. And Wall Street told you that was a feature, not a bug. Private credit managers told investors that because these assets are private and held to maturity, they are not being constantly repriced by panicky emotional markets. So, the pitch was that you could earn stable high yields without all that stomach churning, sleepless night volatility during the upswing. When money was basically free and the global economy was ripping, that sounded like a dream. But here is the deal. The other side of less mark-to-market noise is this. If there is no active, public market price, the fund manager has to model the value themselves. And once stress begins to rise in the real economy, that internal model becomes a total, complete game of make-believe. If the model says the loan is worth 98 cents on the dollar, the fund net asset value looks totally fine, and the manager keeps collecting their fat, luxurious fees. But if the market would only pay 80 cents for that exact same loan, that is a completely different story. If the banks lending against those assets start thinking the real number is 80 while the fund is still shouting 98, that becomes a massive, catastrophic funding problem. If investors think the real number is 80 while the fund says 98, that becomes a massive, chaotic redemption problem where everyone runs for the exit at once. And if the DOJ is now asking questions about these valuations, it is becoming an oversight problem that could lead to something much, much worse. Again, no wrongdoing has been proven. We are not saying this is straight up fraud, though there has been plenty of fraud in private markets history. We are saying that this is the precise fault line that critics have been warning about for years. One of private credit's biggest weaknesses is its total opacity. And the reason it is a weakness is because it hides bubble behavior, garbage lending, and the potential for serious, devastating losses. Now that opacity is being tested as we get more signs pointing toward trouble, the Bloomberg report on BlackRock is a major development, not because BlackRock is some fringe unknown player, exactly the opposite. BlackRock is the biggest asset manager on the entire planet. It is as mainstream finance gets. And that is what makes this so important and so terrifying for the status quo. For the last year, private credit defenders tried to explain every problem away as just an isolated case. Oh, one borrower went bankrupt, that is a one-off. Oh, a business development company is trading at a huge discount, that is just over emotional investors. A lender using too much payment in kind, oh, that is just normal, they said. But once the concern reaches a BlackRock fund, the isolated argument becomes absolutely impossible to maintain. It means the valuation question has moved from critics and short sellers into the regulatory and potential law enforcement spotlight. And that matters because valuations are not just an accounting matter. Valuations are the foundation for everything. They determine reported performance, they determine fees, and they are where investors feel comfortable leaving their money in the fund. In private credit, The mark is the story. The entire boom was built on the idea that those marks were reliable enough to trust with your life savings. So the question now is not what if investors stop trusting them. It is how far has this mistrust already gone to the point that it could see the inside of a federal courtroom. This is why people call it mark to myth. In public markets, there is at least a price. It might be volatile, you might hate it, but it is public and it is established by a fair market process. But in private credit, the value depends on models, internal assumptions, and black boxes. During the bubble years, nobody cared, but during the downside of the cycle, the assumptions matter a lot more. If a company can no longer pay cash interest and is paying in kind, is that loan still worth par? If similar loans in the liquid market are trading at 80, why is the private loan still marked at 98? These are no longer theoretical questions, they are sitting at the center of the private credit story. The BlackRock probe validates the concern that private credit funds might be marking assets in a way that delays the recognition of losses. And that is the entire ball game. We are seeing the biggest names, KKR, Apollo, and BlackRock, all having to deal with the aftereffects of the bubble if the biggest names are neck deep in the cleanup. Just imagine how much garbage is out there in the rest of the system. We can see this in the public business development companies, the ones that give us a window into this world. When Carlyle cuts its dividend, that is a signal that the income engine is under pressure. When Blue Owl buys back 85 million in shares, they are trying to fix a crisis of confidence. They can call it a sign of confidence, but the reason those shares are trading so low is because the market does not believe the net asset value anymore. This is the transition from stage 1 to stage 2. Stage 1 is when a few smart people pull back. Stage 2 is when the pullback is broad enough that managers, banks, and regulators all start to react. We are in that phase now. So, what should we watch from here? Watch the discounts, watch for more dividend cuts, monitor the non-accruals and payment in kind interest, and keep a very close eye on what the insurance companies are doing. They are the massive funders of this whole machine. If they pull back, the party is officially over. The private credit bubble depended on trust, and now that trust is being tested, that does not mean everything is going to zero. But it does mean that credit cycles have not been repealed. It does not need a massive Lehman moment to cause serious economic damage. Sometimes all it takes is for the trust in the marks to break, and the credit machine starts to slow down. And once it slows, the damage moves from the funds to the companies and then to the real economy. Stay disciplined, stay liquid, and keep your eyes wide open. You need to build your own fortress. Stop looking for the magic trade that makes you a millionaire overnight. It does not exist. Instead, put your capital into assets that produce actual, real, tangible cash flow. When I look at my own portfolio, I keep 70% in broad market index funds like VU because I want to capture the growth of the best businesses on earth. I put 20% in high-quality dividend growers like SAG because I want to be paid to wait while the world goes crazy, and I keep 10% in high-growth assets like VUG because I want that extra upside when the cycle inevitably turns back in our favor. This is the boring, unsexy, but incredibly effective strategy that wins in the long run. While everyone else is losing their shirts trying to time the next big market swing or chasing a speculative bubble, you should be doing the opposite. You should be buying when they are fearful and holding when they are greedy. Most of you are losing money because you treat investing like a casino, but you need to treat it like a serious, long-term business. You are the CEO of your own financial future. Every dollar you waste is a dollar that could have been compounded into something much bigger. Think about the 20-year timeline, not the 20-minute news cycle. The news cycle is there to keep you distracted, stressed, and reactive. But your money needs you to be patient, calm, and proactive. If you can stay disciplined when the headlines are screaming and the market is shaking, you are already ahead of 99% of the population. I have been there in the early days. I made every mistake in the book. I tried to pick the next big winner. I tried to time the market. I lost money on options, and I realized that I was just gambling. It was a painful lesson, but it was the best lesson I ever learned. It taught me that the market does not care about my feelings or my desire to get rich quickly. It only rewards patience and consistency. So now I just do the work, I save, I invest, and I wait. When the market drops, I do not panic. I view it as a discount on the assets I want to own. When the market rises, I do not get overconfident. I keep my plan and stick to my strategy. This is the only way to build sustainable wealth. The private credit bubble is just one small part of the bigger picture. There will always be another bubble, another crisis, and another reason for people to panic. But if you have a rock-solid strategy, none of that will break you. You will be the one standing when others fall. You will be the one buying the fire sale when others are forced to sell at the bottom. That is the position you want to be in. It takes a lot of mental toughness, and it takes the ability to ignore the noise. But I promise you, it is worth it. Everything I talk about on this channel is based on the idea that you can take control of your own destiny. You do not need a financial advisor taking a cut of your earnings, and you do not need the latest hot stock tip. You just need a plan, discipline, and the courage to stick to it. The credit cycle is turning, and it is going to get bumpy, but if you are prepared, it is not a reason to be scared. It is a reason to be excited for the opportunities that are coming. Keep building your cash position, keep your debt low, and focus on your long-term goals. The people who win in the end are the ones who can maintain their focus when everyone else is distracted. So keep your head down, keep working, and keep investing. I really appreciate you being here and listening to these tough truths. We are going to get through this cycle together, and remember, The best time to start was yesterday, but the second best time is right now. Stay disciplined, and I will see you in the next one. Look, I want you to really think about the math behind all of this. If you are currently sitting on a pile of cash, you might feel like you are missing out on the market run. But patience is an asset all on its own. In a market where valuations are stretched and the underlying risks in shadow banking are being ignored, having liquidity is the most powerful tool you have when the market eventually corrects. And it always does. Those with cash are the ones who set the price. You become the buyer of choice. You are not desperate, you are not leveraged, and you are not tied to a failing business model. You have the freedom to choose. Most people are held hostage by their own lack of preparation. They are leveraged to the hilt, they are overextended, and they are one paycheck away from being forced to sell at the worst possible time. Do not be that person. Be the person who has the discipline to live below their means, to save aggressively. And to wait for the right moment, it takes a level of self-control that is rare in today's world, but that is exactly why it works. Success is not about what you do once in a while, it is about what you do every single day. It is the small, consistent habits that stack up over years to create life-changing wealth. The compounding of your money is slow, it is boring, and it takes time. But it is also the most reliable way to build a fortune that actually lasts. I have seen so many people try to skip the process, try to find a shortcut, and it never ends well. The market always has a way of balancing the scales. So just focus on your own game, ignore the noise, and stay consistent. The world might be on fire, but your portfolio does not have to be. You can build a hedge against the chaos simply by being smart, patient, and prepared. This is the reality of the game, and I am here to help you play it the right way. We have a long road ahead of us, and there will be plenty of ups and downs. But as long as you have a plan, you can weather any storm. I am not just talking about money. I am talking about your mindset, your discipline, and your ability to stand firm when things get tough, because at the end of the day, your success is a reflection of your habits, not your luck. So keep pushing, keep learning, and keep building. The opportunities are out there for those who are ready to take them. Thank you for your time, your focus, and your commitment to your own growth. Let us keep moving forward, and I will see you in the next video. One last thing. Do not forget to look at the link in the description for the full deep dive into how I am personally positioning my capital for the coming years. It is all about being prepared before the market moves. Stay strong, stay focused, and keep stacking those assets. We are in this together, and I will see you soon. I want to take a moment to talk about why the psychological aspect of this is just as important as the math. When you see your net worth swing, it is easy to let your emotions take over. It is easy to get scared when the market is red, or to get greedy when the market is green, but the best investors are the ones who can completely detach their emotions from their decisions. They look at the numbers, they look at the facts, and they make their moves based on a clear, pre-planned strategy. If you are reacting to the news, you are already behind. You have to think before the event happens. You have to plan for the crisis before it even begins. That is how you turn a crisis into an opportunity. It is the difference between a gambler and a professional, and that is the transition you need to make. It is not easy, and it takes time to develop that kind of mindset. But it is the key to everything, so keep practicing that, keep refining your strategy, and keep looking at the long-term picture. The noise of today will be forgotten tomorrow, but your financial decisions will stay with you forever. So make sure you are making them for the right reasons. I am here to support you in that process, and I am here to share everything I have learned along the way. We are building something real, and that takes grit, patience, and a lot of discipline. So let us keep going, let us keep learning, and let us keep growing. Thank you for being part of this journey, and I will see you in the next one. Just remember, keep it simple, keep it consistent, and stay the course. You have got this. The path is clear, even if the road is winding. Stay the course, keep your head up, and never stop building. I am proud of you for taking this seriously. And I know you have the potential to reach your goals. Just keep working at it. One day at a time, I will be right here with you every step of the way. See you later.